This episode of Talk Your Book is proudly brought to you by Stock Doctor.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Chris Lott, thanks for coming on Talk Your Book. I know you had some initial concerns that I wasn't going to dress like an adult for your appearance. I wore my best suit, put a tie on. Are you comfortable? This is befitting of your...
It's very impressive. I just hope the camera can't get the socks. And,
why don't you start by telling us a little bit about IP Generation?
Sure. So IP Generation's a couple of years old now. We're a small commercial real estate investor. Our mandate is pretty typical of the current environment. It's really opportunistic. It's very hard to describe what that actually is, and we've invested in projects from 10 million up to 120. So looking for things that are mispriced. Generally we're acquiring off market, and in all instances we're a lead investor. So we're looking to hold 10 to 20% of each of the projects and bring in a consortium of co-investors, wholesale investors, generally widely held. Minimum investments typically of $500,000, right up to a 20% interest in a project.
And what asset do you want to talk about today?
Today we've gone unconditional on a contract to acquire a sub-regional shopping centre in North Geelong, Victoria, the Corio Central Shopping Centre, which we've acquired for around about $100 million, and currently out raising funds for the equity. We're raising $58 million.
Just give us a helicopter view of the metrics of that investment.
So it's a large piece of real estate. It's roughly 85,000 square metres of land. The shopping centre that has been there for over 40 years is about 33,000 square metres of building. It's largely underpinned by a Coles and Woolworths and Kmart, and there's around 60 smaller tenants within the building. On the $100 million purchase price, the year one income is about 9 to 9.5 million, so an unlevered yield of about 9 to 9.5%. The expiry profile of the tenants on average is just over 4.5 years, and the turnover for the entire centre is about $160 million. So it's an interesting play for us. It's our first large retail play, and in this particular environment where there's some large headwinds facing retail, it's a fairly counter-cyclical play, we think, and that's where we see the opportunity.
So an unlevered yield of 9% is massive in the current climate, with interest rates in particular where they are. Is that a real result of just retail being on the nose? And do you think investors fully think they lump retail assets all in one, or do you think they separate non-discretionary and discretionary retail? And how do you view those two matters?
We certainly class non-discretionary and discretionary retail differently, but I think it's still a retail asset.
Yeah.
We're buying at a 9% yield because there is a great deal of uncertainty on the sustainability of rents on retail assets.
Yeah.
And so there is the expectation and the view of a number of people and experts that a 9% income yield on this asset may be unsustainable. We obviously have the different view. We believe that 9% income is sustainable and even a base that we can grow from. But that's where the risk is at the moment, and there's all sorts of headwinds hitting retail, but particularly discretionary retail. Part of the attraction to this one is that it is largely non-discretionary retail, and for us it almost feels akin to social infrastructure.
And so why have you got a differing view to what some experts have, and what will you do to repurpose the property to maintain those sort of yields?
It's been here for over 40 years. It's very much, for us, the city centre for North Geelong, and well positioned to capture a lot of the growth that's occurring now between North Geelong and Werribee. The tenancy mix has evolved quite considerably, even over the last 5 to 7 years that we've been able to track it. And new tenants, largely service-orientated tenants, have been drawn into the centre. So there's a large centre link, there's an employment agent, a doctor, a dentist, a denture clinic. So its use has evolved over time, and I think we need to evolve with that. But it's a community asset. It feels, as I said, a social infrastructure asset. So we just need to adapt to that, and I guess listen to the community and what they're crying out for. But that's where the opportunity sits for us, and to be a very active and local landlord, we just need to evolve with the requirements.
And 2,200 square metres of unlettered space in the basement. What could go in that space? And are there any other opportunities across the property that could lead to a re-rate?
So the basement is quite a bizarre situation. It's something we stumbled across. It wasn't disclosed to us. It just came out through our due diligence that there was 2,500 square metres
a big space.
of subterranean land, which from what we can tell at one stage was a bowling alley, maybe 20 to 25 years ago. And there was a discount retailer in there about 12 years ago, but has been completely unoccupied since and hoarded up. So we think that's low-hanging fruit for us. We've gone into design development stage to actually increase access down there from a pedestrian patronage, but also a goods entry point. For us, even if that's a really low rent of $150 a square metre, that's an extra $300,000 of income, which was not disclosed to us and not factored in. So it's an opportunity there. We've got a very large site. We've got 1,500 car spaces on the site. We don't currently have a requirement for that many car spaces, so we think there's an opportunity for pad sites on the Bacchus Marsh Highway, and that might be fast food, it might be drive-through coffee or car wash. So I think there's some of the low-hanging fruit opportunities for us. And then I think in the medium term, certainly looking very closely at an entertainment and food precinct.
And buying it off a Vicinity, who are respected property investors, why do you think they're selling the property?
I think they've been pretty public that this is not core for them. That they've made it very clear that their strategy is large supercentres like Chadstone and Emporium, and they're capital-hungry assets, and I guess have a requirement for liquidity in these non-core assets so they can focus their time and capital onto those assets.
There's a bit like there's a thing with demerged assets on the stock exchange. When companies demerge, all of a sudden they're treated with a lot more attention because they're the main focus of that new business rather than being a business unit that was unappealing to the old larger company. Is that sort of how you view some of these assets that are non-core to their current holders? Once they get a little bit more love, they can be managed in a different, more effective manner?
For sure. A real practical example of that is the number of bodies that we have on this. So the current Vicinity team has a full-time headcount of 3 management staff on the asset. We'll literally have 6 full-time dedicated staff there, plus 3 part-time. We view this very much as an operating business. There are 90 different revenue streams here. And so we almost consider ourselves a private equity style investor in the way we're looking at this asset, where we've got a really clear strategy over the short, medium and long term to work towards that exit.
And 9% unlevered yield, you're going to have around 50% debt on the investment. So forecast distributions are 10% to unit holders. What could you distribute if you didn't hold any money left over for CapEx?
Well over 12%
Yeah.
Is the short answer to that. But we've taken the view at this stage that we'll be capping those income distributions at 10 and more or less building up a war chest over the initial 5-year period and being really strategic with how we're reinvesting that back into the asset.
And you look at IMs like this and the number of risks is a mile long around anything that's ever posed a risk to man. What were the main risks that you looked at in this, the 2 or 3 that you really had to get comfortable with before you could put your own money in and recommend it to your investors?
I think the first thing you'd look at with any regional, sub-regional shopping centre, or even any shopping centre really, is the strength of your anchors. And Coles, Woolworths and Kmart are the big anchors anchoring Corio. Really, really strong performers. So combined Coles and Woolworths is around $90 million of turnover. They've been there, as I mentioned, for over 40 years. So they've really captured that community.
So when you're saying the strength of the retailers, you're looking at the strength of the parent company, but also how the actual on-site business is performing.
Definitely.
And so as a percentage of turnover, what's this rent for those businesses?
It's around 3% for those guys.
And is that the sort of number you look for in retail industry?
Yep.
Same for specialties?
No, specialties will have a higher benchmark, typically 14%.
Yeah.
For specialty stores, depending on who the operator is and the business that they're in, but 14% is fairly healthy, typical benchmark for specialty.
And will you keep watching that rent as a percentage of turnover going forward to potentially red alert you if things have changed in the environment?
Absolutely. And the absolute majority of our due diligence over the last 3 months has been literally tenant by tenant income auditing and,
Yeah.
and taking a view on the sustainability of their rents and what sort of decision-making process they're going to be going through at their next expiry.
What do the demographics of the area look like?
So North Geelong, Corio is a relatively low socio-demographic. It's an older demographic. It is certainly gentrifying. So as you know, that the western corridor of Melbourne is a very fast-growing corridor. And I'd say over the last 10 years, the majority of that has occurred in the inner west, as well as south of Geelong. But over the next 10 to 15 years, there's a considerable amount of that growth now coming into that northern area of Geelong, where it's far more affordable. But currently, as I've mentioned, very low socio-demographic.
And what were some of the other risks you really got comfortable with along this process?
Getting a great deal of transparency over the last 7 years of the evolution of this asset. And so you get the transparency on tenancy turnover, as in retail expenditure turnover, as well as the churn of those tenants. And it's just proven to be a very resilient asset in terms of its turnover numbers have consistently grown for those reporting turnover. And the centre as a whole has consistently grown. But it's also been nice to see that it has been able to evolve over that last 7 years, and the move towards service-based tenants within shopping centres is a national and possibly global trend, and it has evolved really nicely to that. It's maintained a very low vacancy level. Currently, 2% of it is vacant, so 3 shops, which is probably going to be a healthy level of vacancy for us going forward.
Beautiful. Thanks for joining us on Talkie Book. Hope it goes great.
Thanks, Chris.
Thanks, mate.
If you're interested in building your own investment process, make sure you check out Stock Doctor, the proud partner of Talkie Book.